I wish that was the case. I don't think that's going to be easily the case. In fact, I think we're going to have to see the unemployment rate rise pretty significantly from where we're at right now to get to the Fed's 2% target sustained and really derail the underlying inflation that we have building out there. And I think, the Fed's goal, of course, at the end of the day is to have inflation not influence our behaviors at all. And there's no question that inflation is skewing not only household behaviors, but now firm behaviors as well. And I think that's very important to keep in mind as we go into the fall, that, even as inflation cools, will it cool enough to not become more entrenched? And the Fed wants to avert that mistake of the 1960s and 70s that delivered us the stagflation by not going far enough to derail the inflation that we've got.
Yeah, because it seems like all of the headlines about recession are going to complicate this effort by the Fed to fight inflation. They're going to make it sound to the public, maybe even to policymakers themselves, like they shouldn't risk tightening too much into a downturn, when in fact, perhaps they should be tightening more into an acceleration of inflation. What did you make of this pickup in the PCE readings? 1% for the headline last month. That's with gasoline prices dropping. 0.6% for the core. That excludes food and energy entirely.
Yeah, and we're going to see somewhat better numbers in July and August, but I think the Fed is on the right side of this, saying, listen, we're not going to go on the laurels of supply suddenly coming up to meet demand and inflation sort of unwinding and uncoiling itself with these supply chain problems. There could be additional supply shocks out there. And exactly the thing the Fed should be worried about is more persistence. Even if we see some improvements in these numbers, which I do think we will in July and August, that may not be enough. And we could get hit again. And I think the Fed is on the right side of saying, we still got to be tightening here. And we still got to be, we may adjust how much we tighten. We got a lot of data between now and September. I think it's at least a 0.5% move in September, if not another 0.75% move by the Fed. And only that would bring monetary policy into what's considered tight. But also remember, in September, we'll be seeing that full balance sheet run off by then as well. And that's going to amplify rate hikes and the tightening of credit market conditions in ways that nobody knows exactly how. That's something that's difficult for the Fed as well. And nobody, including the Federal Reserve, knows exactly how reductions in their balance sheet are going to play out over the next 6 months.
Yeah, and I think in that sense, we're all right to look to the markets and say, okay, when break evens were soaring, they were warning the Fed was behind the curve. Now that they're correcting, we can perhaps trust and take some comfort from that return to more of a long-term trend. Real quickly, there's this debate, I guess, kicking up between Larry Summers and Chair Powell, or at least coming from Larry Summers, about whether we've reached neutral on the interest rate or not. Yes, we're now up around 2.25%, maybe 2.5% on Fed funds. Summers says there's no way that's neutral with the inflation rate so high. Does all of this matter? I mean, what is the destination point, do you think? Is the Fed going to be able to get there? Do you think they're going to be cutting rates in the early part of next year?
I actually don't think they're going to be cutting rates in the early part of next year. I think the Fed's going to be raising rates into 2023 and then holding them and seeing, how far that gets them. If they need to go further, they'll go further. I don't think this is a Fed that's willing to risk on, a more entrenched inflation because they're already behind the curve and they've taken the damage to their credibility because of where they're at. That said, that means this is a Fed that's willing to risk a deeper recession. And something that we don't often talk about is that the Fed has no way of calibrating how rapidly the economy slows and how deep any recession we have. They'd like, at worst, a mild recession. They'd like to say we'd raise the unemployment rate a little bit, not too much, and everything sort of ends up okay. But the reality is they don't have the ability and the precision tools to calibrate what happens. And I think the biggest threat to the Fed is that they hit a tripwire and that we see the sins of low rates play out and some seizure in credit markets where they have to intervene,
right,
where inflation and the entrenched inflation we see has not yet been derailed.
Totally agree. And it's interesting. I'm glad we showed it on the screen there. 5- and 10-year inflation expectations have actually picked up in recent weeks, even as gasoline prices have dropped. And, I don't want to call it a policy error, but it certainly suggests that, they see a loosening of precisely the thing we're trying to calm down. Diane, thank you. We'll let you go and have a great weekend. Thank you so much. Diane Swonk, now with KPMG.
Shepard Smith here. Thanks for watching CNBC on YouTube.